Assalamualaikum and good morning. My name is Nur Izzah binti Mama Hawizal. My matric number 272875. I will start present the topic number 3, which is standard cost and variance analysis. This topic has 7 subtopics. First, I will tell you about unit standards. Standards are benchmarks or norms for measuring performance. Variance is the difference between the actual result and the expected performance. The expected performance is also called budgeted performance. Budget set standards that are used to control and evaluate managerial performance. To determine the unit standard cost for a particular input, 2 decisions must be made. The first decision is the quantity decision, and second decision is the pricing decision. Quantity decision is the amount of input that should be used per unit of output. Pricing decision is the amount that should be paid for the quantity of the input to be used. Quantity and price standard. Quantity decision produce the quantity standard, while pricing decision produce price standard. The standard cost per unit can be computed by multiplying quantity standard and price standard. Subtopic number 1, type of standard. Standards are generally classified as either ideal or currently attainable. Ideal standard demand maximum efficiency and can be achieved only if everything operates perfectly. Currently attainable standard can be achieved under efficient operating conditions. Allowance is made for normal breakdowns, interruption, and less than perfect skill. Of the 2 types, currently attainable standards offer the most behavioral benefit. Next, why standard cost systems are adopted? There are 2 reasons for adopting a standard cost system. First, to improve planning and control. Comparing actual costs with budgeted costs identifies variance, which is the difference between the actual and planned cost for the actual level of activity. Overall variance can be further broken down into a price variance or a usage or efficiency variance if unit price or quantity standard have been developed. Second reason, to facilitate product costing. Costs are assigned to product using quantity and price standard for all 3 manufacturing costs, which is direct material, direct labor, and overhead. Standard costing and variance analysis for controlling costs and evaluating performance can have strong ethical implications. Next, cost assignment approaches. There are 3 costing systems, which is standard costing system, normal costing system, and actual costing system. Standard costing system consists of standard direct material, standard direct labor, and standard overhead. For normal costing system, consists of actual direct material, actual direct labor, and budgeted overhead. And last, for actual costing system consists of actual direct material, actual direct labor, and actual overhead. That's all from me. Thank you.
Next, I will explain the second subtopic of Chapter 3, that is setting up standard costs. How standards are developed? There are 3 potential sources of quantitative standard as follows. First, historical experience. It can provide an initial guideline for setting standard, but should be used with caution because they can perpetuate existing inefficiencies. Second, engineering studies. It can identify efficient approach, rigorous guideline, but engineered standards often are too rigorous. Third, input from operating personnel. Since operating personnel are accountable for meeting standards, they should have significant input in setting standards. Standard product costs. In manufacturing firms, standard costs are developed for direct material, direct labor, and overhead. Using this cost, the standard cost per unit is computed. Setting direct material standard. Price standard. It should reflect the final delivered cost of material and net of applicable discount. Quantity standard summarized in a bill of material. A bill of material is a list that shows the quantity of each type of material in a unit of finished good. Setting direct labor standard. For rate standard, many companies prepare a single rate for all employees within a department that reflect the mix of wage rate earned. For time standard, standard can be determined by using available reference that estimate the time needed to perform a given task, or by relying on time and motion studies. Setting variable overhead standard. For rate standard or price standard, the rate is the variable portion of the predetermined overhead rate. For activity standard or quantity standard, the activity is the base used to calculate the predetermined overhead. Standard cost sheet. The standard cost sheet provides the production data needed to calculate the standard unit cost. The standard unit cost sheet also shows the quantity of each input that should be used to produce one unit of output. A manager should be able to compute the standard quantity of material allowed and the standard hour allowed for the actual output. This is example of standard cost sheet for deluxe strawberry frozen yogurt. They are given standard price and standard usage for direct material. To get the total direct material, we must sum all standard cost of direct material. To get the standard cost, standard price times with standard usage. The total direct material is 0.86. Total direct labor is 0.08 and total overhead is 0.26. Total standard unit cost is 1.20. We sum all the total direct labor, total direct material and total overhead. Standard usage allowed. Standard quantity of material allowed for 20,000 cord. Standard quantity equal to unit quantity standard times the actual output. Unit quantity standard of 25 times with 20,000 and get 500,000 ounces. For standard hour of labor allowed for 20,000 cord, standard hour is equal to unit quantity standard times the actual output. 0.01 of unit quantity standard times with 20,000 and get 200 direct labor hour.
City Nur Sakina 272-912. Now I would like to continue to the 3.3 part, that is advantages, disadvantages and also the limitation of standard product cost. As mentioned in the note given, standard product costing has several advantages over normal costing and actual costing. So, first one is standard costing has greater capacity for the control. As we know, this system used to identify variance by comparing actual cost with budgeted cost, so that it allows managers to look for ways to improve cost control, cost management, and operational efficiency. Second, because of the standard product costing use estimated cost, so that it provides readily available unit cost information that can be used for pricing decisions at any time. Next is no unique cost calculation for each equivalent unit category in process costing. The last one is no need to distinguish between FIFO and weighted average methods of accounting for beginning inventory cost. Okay, for this slide explains about advantages of using standard costing. First, the use of standard cost is a key element in a management by exception approach. If costs remain within the standards, managers can focus on other issues. When costs fall significantly outside the standards, managers are alerted that there may be problems requiring attention. So, this approach helps managers focus on important issues. Second, standards that are viewed as
reasonable by employees can promote economy and efficiency. They provide benchmarks that individuals can use to judge their own performance. Third, standard costs can greatly simplify bookkeeping. Instead of recording actual costs for each job, the standard cost for materials, labor, and overhead can be charged to jobs. Last is standard costs fit naturally in an integrated system of responsibility accounting. The standards establish what costs should be, who should be responsible for them, and what actual costs are under control. Now, there also have potential problems with standard costs. First, in some cases, the profitable variance may be misinterpreted where it may be bad or worse than the unfavorable variance. For example, McDonald's has a standard for the amount of hamburger meat that should be on the Big Mac. The profitable variation would mean use fewer meats than the standard one. So the result is poor quality Mac and possibly customer has a dissatisfied. Second, if the manager is not sensitive and use the variance report as a club, the spirit may suffer. The subordinates may be tempted to cover up unprofitable variations or take action that are not in the best interest of the company to ensure those variations are profitable. For example, employees may work hard to increase output at the end of the month to avoid poor workforce variation. So, the rush to produce quality output may suffer. Third, there may be a tendency with standard cost reporting system to emphasize meeting standards by excluding other important objectives such as maintaining and improving quality, timely delivery, and customer satisfaction. This tendency can be reduced by using additional performance measures that focus on other objectives. Fourth, meeting standards may not be enough, so continuous improvement may be needed to survive in the current competitive environment. For this reason, some companies focus on standard cost variation trends aimed at improvement rather than just meeting standards. In other companies, engineering standards are replaced either by rolling average from actual costs, which are expected to decrease, or by very challenging target costs. Last but not least, standard product costing have few limitations, which are first, standard product costing is costly and expensive. Why? Because the task for setting the standard is very difficult and it involves a high degree of technical skill. Second, because of the conditions of the business are changing, standard must be revised from time to time, otherwise they lose importance. Third, fixation of standard is not possible for every type of work or operation. For those industries which do not produce any standard product, it cannot be. Fourth, sometimes it creates adverse psychological effects. If it is set at a high level, its non-achievement results in frustration and boosts up resistance. It acts as a discouragement rather than incentive for better efficiency. Fifth, it is partly determined on the basis of past experience, partly on the basis of forecast of future expense. Thus, uncertainties are around standard and determination of correct standard is very difficult. The last one is too much care and attention are required to introduce as well as to keep up to date the system. Otherwise, the very purpose of the system will be frustrated. So that's all from me. Let's move to the next presenter.
Hello everyone. Today I want to present my part, which is variance analysis. Variance is the difference between actual and standard cost, where actual input cost can be calculated as actual cost equal to actual price per unit times actual quantity of input used. It is also possible to calculate the cost that should have been incurred for the actual level of activity, where planned cost equal to standard price per unit times standard quantity of input allowed for the actual output. Next, we look to total budget variance, where the total budget variance is the difference between the actual cost of the input and its planned cost. So the formula here states as total variance equal to actual cost minus planned cost. As we know, actual cost is actual price per unit times actual quantity of input used minus with planned cost, where planned cost is standard price per unit times standard quantity of input allowed for the actual output. It's the same as general description that we just learned before, where variance is the difference between actual and standard cost. There's a reason why we have to separate the total variance into price and usage, because responsibility for deviations from plain price tends to be located in the purchasing or personal department, while responsibility for deviation from plain usage of input tends to be located in the production department. Next, we look into a general model of variance analysis, where they have two types of variance, which is price variance and quantity variance. Price variance is difference between actual price and standard price, while quantity variance is difference between actual quantity and standard quantity. As we look more, under price variance, they have another three difference variance, which is material price variance, labor rate variance, and variable overhead spending variance. While for quantity variance, they have material quantity variance, labor efficiency variance, and variable overhead efficiency variance. First, we will look into material variance for price and quantity. But before that, we have two types on how to calculate the variance, which is using table form or using formula. On your screen right now, we are using table form. For formula, we will look after this. For table form, you have to find each of these green box so that they can lead you to answer for price variance, quantity variance, and for total variance. As we can see, for price variance, you got it from actual price times actual quantity minus with standard price times actual quantity. For quantity variance, you will get from standard price times actual quantity minus with standard price times standard quantity. It's the same applications as before for total variance, which is actual minus standard. It's the same. When for you to use the table form is depend on the questions. If the question asks you to use in the table form, you guys have to do it exactly like here. But if the question didn't ask any types of forms or formula, you guys can just use formula, because formula is much more easier. So we will look after this. So here is the formula for material price variance, where MPV equal to AP minus SP, then multiplied by AQ. To make it more clear, here are examples that we can use for formula. We will look after this on how to find material price variance and direct material quantity variance. As we can see here, this is a formula for material price variance where MPV equal to AP minus SP then multiplied by AQ. All the information here we can get it from the questions before, where actual price, this is how to find material price variance for yogurt. So we will look into yogurt only. So actual price per ounce of yogurt is 0.025 minus with standard price ounce for yogurt is 0.020, then multiplied by 780,000, where this is actual yogurt usage. So you will get $3,900 for material price variance. Direct materials quantity variance, the formula is MQV equal to AQ minus AQ then multiplied by SP. AQ is actual quantity of materials used, SQ is standard quantity of material allowed for the actual output, and SP is standard price per unit. Next, we're going to find direct material quantity variance for yogurt. The question asking for yogurt, so we're going to find for yogurt only. The formula is MQV equal to AQ minus SQ then multiplied by SP. The information just plug in from the questions and just use it in the formula, so you will get the answer $600. So we are going to look for labor variance, rate, and efficiency. As we know, we have two types on how to calculate the variance. First, using table form, or second, using formula. Actually, we apply the same way on how to use the table form and same way on how to use the formula. First thing first, we have to find what is actual hours, actual rate, standard hours, and standard rate, so that after that we can find rate variance and efficiency variance. All of these are used in both on table form and using formula. Here are the formula for labor rate variance, where LRV equal to actual hourly wage rate minus with standard hourly wage rate, then multiplied by actual direct labor hours used. And we are going to find labor rate variance. As we know, the formula is AR minus SR, then multiplied by AH. All of this information are from the previous slide, where you guys can look at standard cost sheet and price and quantity variance from material variance, where we learned before. So the actual rate here is $8.20 minus with $8, then multiplied by actual hour, which is 325. So the final answer will get $65. Next is formula for labor efficiency variance, where LEV equal to actual direct labor hours used minus with standard direct labor hours that should have been used, then multiplied by standard hour wage rate. We are going to find LEV. As we know, the formula is AH minus SH then multiplied by SR. The actual hour are 325, but for standard hour, we are going to find standard direct labor hours that should have been used. The keyword here is that should have been used. When we go check back to our standard cost sheet, the machine operation at $8 multiplied by 0.01 hour. That 0.01 hour, you have to multiply with total production, so we will get the standard direct labor hours that should have been used. So here are 0.01 multiplied by 30,000, then you will get 300. And after that, you multiply with $8 here and you will get 200. The final answer is $200. Next, we move to variable overhead variances. We're going to find spending and efficiency. It's the same as material and labor, which is we have two types on how to calculate the variance. Either using table form or using formula. The same way we apply using table form, we're going to find actual variable overhead, actual hours, we're going to find variable overhead rate, and we're going to find standard hours. All of this information going to lead to you the answer for spending variance, efficiency variance, and total variance. It also can help you to find using formula. Here are the information given for variable overhead variance that we are going to use to find variable overhead spending variance and variable overhead efficiency variance using formula. Next is about variable overhead spending variance, where the formula is AVOR minus with SVOR and multiplied with AH. The actual variable overhead rate is actually you have to find it by yourself, where the actual variable overhead cost divide with actual hour work, because it is to find each rate for every hour. So the each rate for every hour is $5.80. You get it from $7,540 divide with 1,300, and you will get $5.80. Then minus with $6, you can get it from variable overhead rate standard and multiply with actual hour. The actual hour here is 1,300, and the final answer is $260. Move to variable overhead efficiency variance, where the formula is AH minus SH then multiplied with SVOR. The actual hour here is 1,300 minus with 1,200. This 1,200 you can get it from the previous slide, where hours allowed for production. Then multiply with SVOR. The SVOR is $6. Then the final answer you will get $600. Then we move to the last part is fixed overhead variance. This is information for fixed overhead variance that we're going to use in formula and in table form. Formula for applied fixed overhead is standard fixed overhead rate multiplied with standard hour. The standard fixed overhead rate here is $20 and multiplied with 1,200. So the answer is 24,000 for applied fixed overhead. Total fixed overhead variance, when we apply back to general information before, were actual minus with standard, right? So the actual fixed overhead cost here is 20,500 minus with applied 24,000, then you will get 3,500. It is over applied because the applied is more than actual. Here are in table form for fixed overhead variance. Same way we applied before for material, labor, and variable. It's the same way. So you guys have to plug in the information and just do the calculation, and you will get the answer for spending variance, volume variance, and total variance. Here are the formula for fixed overhead spending variance, where AFOH minus with BFOH. So AFOH stand for actual fixed overhead, while BFOH stand for budgeted fixed overhead. You can get from the previous information for fixed overhead variance, where AFOH is 20,500 minus with budgeted 20,000, and you will get final answer is $500. A table for fixed overhead spending variance, but in each item, the item here are depreciation, salaries, tax, and insurance. So the variance for each item, you guys have to actual minus with budget, and you will get the variance. So as we can see here, the final answer is 500, which is it's the same answer as fixed overhead spending variance. The last one is fixed overhead volume variance, where budgeted fixed overhead minus with applied fixed overhead. You guys have to take the information from previous slide and plug in the formula, and you will get the final answer is $4,000. Here are unfavorable and favorable variances, where unfavorable variances occur whenever actual price or actual usage of inputs are greater than standard price or standard usage. So basically it says actual must be greater than standard, so it will be unfavorable. But when the opposite occurs, favorable variances are obtained. Favorable variances obtained when standard greater than actual. Favorable and unfavorable variances are not equivalent to good and bad variances. The terms merely indicate the relationship of the actual price to the standard price.
Hi and Assalamualaikum. My name is Nur Ali binti Jamli and metric number is 272728. I will continue with 3.5 Advanced Variance Analysis, Mix and Yield Variances, Material and Labor. Standard mix information for direct material. Okay, direct material peanuts 1 to 5 lbs, meat proportions 0.8%, standard price $0.5 and standard cost $64. For almond 32 lbs, meat proportion 20%, standard price $1 and standard cost $32. So the total of mix is 160, total for standard cost is 96. Year 120 and year ratio 0.75. Please remember this one because we will use it later. How to get 0.75? The total of year 120 over total of mix 160. Standard cost of year $0.8. Malcolm Nuts Company produced batch of 1,600 pounds and produced the following actual result. Direct material peanuts actual meats 1,120, percentage 70%, almond 480, 30% percentage. So the total of actual meat is 1,600. The yield is 1,300 and the percentage 81.3%. Standard mix equals to standard mix proportion times total actual input quantity. For peanut 0.8% times the actual quantity 1,600 pounds equals to 1280. Standard mix for almonds 20% times 1,600 equals to 320 pounds. So mix variances equals to actual quantity minus standard mix times standard price. Okay. For peanuts, actual quantity 1,120, almond 480, standard mix the amount that we just calculate just now. Okay, actual quantity minus standard mix. For peanuts negative 160, almond 160, standard price $0.5 and almond $1. Okay, actual quantity minus standard mix times standard price. For peanut we will get negative $80 and almond $160. So the mix variance equals to negative $80. Direct material yield variance. Standard yield equals to yield ratio times total actual input. Okay, yield ratio the one that I asked you to remember 0.75. 0.75 times 1,600 and then we will get the answer. We will get the answer of 1,200. Okay, standard yield minus actual yields 1,300 and times standard price for yield $0.8. So we will get the yield variance of $18. Labor mix and yield variances. For standard standard mix information, label type shelling 2 hours, 3 hours, mix proportion 16%, standard price $8 and standard cost $24. Mixing 2 hours 40%, standard price $15 and standard cost $30. So the total of mix is 5 hours and standard cost $54. Yield 120 lbs, yield ratio 24. Standard cost of yield 0.45 per pound. Markham processes 1,600 pounds of nuts produce the following actual result. Label type shelling 20 hours, mix percentage 40%, mixing 30 hours, percentage 60%, and total is 50 hours for actual milk and total mix percentage 100%. The yield is 1,300 and yield percentage 3 2,600. Sorry. Okay, so we will use 50 hours as the base. Label type shelling, actual hours 20. How to find the standard mix is standard mix equals standard mix percentage times with actual quantity. Okay, so standard mix for shelling is 30. Actual hours minus standard mix negative 10 and standard price $8. Actual hours minus standard mix time over standard price is negative $80. For mixing 20, 30, 20, 10, $15 and $150. So direct labor mix variance is negative $70. Using the standard mix information and the actual result, the yield variance is computed as follows. Yield variance equals to standard yield minus actual yield times standard price yield. And then we will get the answer as $45. The yield variance is favorable because the actual yield is greater than the standard yield. So that's all from me. Thank you.
Hi, good day everyone. My name is Wanida and my number metric is 272784. So I will present 3.6 planning and operational variance analysis. So planning variance or revision variance is a compare an original standard with a revised standard that would have been used if the planner had known what was to happen. And for operational variance or operating variance, compares an actual result with the revised standard. So let's look at example. At the beginning of 2000, WB set a standard marginal cost for its major product of $25 per unit. The standard cost is recalculated once a year. So actual production cost during August 2080 were 304,000 and actual unit 8,000 produced. With the benefit of hindsight, the management of WB realized that realistic standard cost for current condition would be $40 per unit. The planned standard cost of $35 is unrealistically low, so question required, calculate the total planning and operational variance. So planning variance is the difference between standard cost and revised standard. So standard cost 8,000 times $35 equal to 200,000 and revised standard 8,000 times with $40 equal to 320,000. So the difference between standard cost and revised standard is 120,000. And for operational variance is a difference between revised standard and actual cost. So revised standard is 8,000 times with $40 equal to 320,000. And the actual cost is given in the paragraph 304,000. So difference between revised standard and actual cost is 16,000. So the total variance is the difference between planning variance and operational variance. So equal to 104,000. For traditional variant, is the difference between standard cost and actual cost. Standard cost 8,000 times with $25, 200,000. And the difference between standard cost and actual cost is 104,000, similar with the previous one. So next one is 3.7 variant investigation. If variance is significant, investigation is needed to find out the causes for such variance. Based on the finding, corrective action may be taken if necessary. Investigating variance is a key step in using variance analysis as part of performance management. So factors to consider is size. First one, a standard is an average expected cost, and therefore small variation between the actual and the standard are bound to occur. These are uncontrollable variance and should not be investigated. In addition, a business may decide to only investigate variance above a certain amount. The following technique could be used. First one, fixed size of variance. Investigate all variance over $5,000. And then fixed percentage rule. Investigate all variance over 10% of the budget. Or statically decision rule. Investigate all variance of which there is a likelihood of less than 5% that it could have arisen randomly. Second one is favorable or adverse. Firms often treat adverse variance as more important than favorable, and therefore, any investigation may concentrate on this adverse variance. And then, third one is cost. For investigation to be worthwhile, the cost of investigation must less than the benefit of correcting the cost of the variance. And the past pattern, variance should be monitored for a number of periods in order to identify any trend in the variance. A firm would focus its investigation on any steadily worsening trends. And then for the budget may be unreliable or unrealistic. Therefore, the variance would be uncountable and call for a change in the budget or an improvement in the budgeting process, not an investigation of the variance. The last one, reliability of figures. The system for measuring and recording the figure may be unreliable. If this is the case, the variance will be meaningless and should not be investigated. That's all for today's presentation. Thank you.